So this leaves me with an analysis on Nvidia and AMD to consider. So Nvidia and AMD recently have been selling for, in my opinion, below where they should be selling for. There are probably some reasons for that. I think there is fear in Wall Street that their growth rates are going to be revised down and that the stocks are already discounting a lot of the value of these revisions down, either because of tariffs or China or, a slowdown in AI or whatever. But what we really have to understand when it comes to these companies is where they're valued now. For options purposes, their volatility is super low right now. But when it comes to their valuations, I like to use a PEG ratio based analysis. Now, some people use this in a very different way, so I'm going to explain the way I do it versus what other people do. Other people will say, well, Kevin, Nvidia has a PEG ratio of under 1 right now, which suggests it's a screaming buy. Okay, but does it? Well, let's analyze it. Well, if you take Nvidia's price, $135, divide their earnings per share for January 2026 into it. I don't like using the trailing 12 months. Divide that in, what do you get? 30.9. Okay, what is their next 4 years of growth expected to be? 15.9. So PE ratio, 30.9, divided by 15.9, what do you get? 1.94. That's the PEG ratio that I think Nvidia sits at now. Now, I personally think their growth rate will be closer to maybe 12 or 10% over the next 4 years, but that's fine. If you compare them, obviously, to the growth rate that's already happened in the past, which Wall Street doesn't care about, then yes, you will get a PEG ratio under 1. So I always like to use a consistent PEG ratio, look at the end of the year's earnings per share ahead of us, and then 4 years of growth thereafter. That's how I get my PEG ratio. So in my opinion, for a service business at a 269, sort of a justifiable PEG ratio, Nvidia could be a $185 company. And AMD could be a 254, let me make sure I said that correctly. Nvidia could be a $185 stock. Okay, not talking about the market cap or whatever. The stock price could be $185, and AMD could be 254 because their PEG ratio is only 1.21. And I think both of them belong somewhere around 2.69 because that's generally where I price software companies. And when I do my PEG ratios like this, I'm able to consistently compare across different industries and various different companies. For example, when I look at Tesla, I think that Tesla is a little bit pricey right now, mostly because if I look at Tesla, first of all, they're a manufacturer. Like they actually manufacture their own products, whereas Nvidia and AMD do not. AMD, for example, doubling down on UA Link in their consortium partnership with Dell and others to compete against NVIDIA's InfiniBand. These are not products they're manufacturing. They're designing them into the infrastructure for these companies, for the data centers mostly. And there's all this fear about walled gardens, like, oh, NVIDIA is going to walled garden us like Apple, so we need to diversify our technology, whatever. It just bodes well for AMD, but I think the whole industry grows and people are going to take what they can get for a meaningful time in the future until AI hits a wall. But look at Tesla, for example. It closed today at 360. It's actually impressive that it broke out over the 347 level. And the earnings per share that are projected for Tesla, they're actually pretty darn good right now because earnings are expected to be so bad this year at just 193. So take 360 divided by 1.93 for the year. Tesla's technically right now trading for a 186 PE ratio. But Wall Street broadly thinks they're going to return to substantial growth next year at 50% growth, 32% growth, 33% growth, and 49.7% growth. These are some of the highest expectations that I've seen for Tesla's growth in a very long period of time. This has always averaged like 28 to 32%. And now if I divide this by 4, I get 41% growth. That's a lot. The problem is I have to now divide it by the price, right? The PE ratio. So 186 divided by 41, the sucker's trading for a 4.5 PEG. That's insane. So if I do 41 times growth and I take 193 on EPS and I do a 167 PEG ratio, we should be at about $1.32, so $132 per share on a simply auto manufacturer and energy business EPS POV, including EPS growth rates in the future. So already including the next 4 years of growth rates assumed by Wall Street in earnings per share, which does discount some earnings for Optimus, robotaxis, semi-trucks, and all of that. So in other words, it's extremely expensive. And when I compare the three companies, this is a tool that I like doing. Now, don't get me wrong. I still like Tesla. I still like my Cybertruck. I just think the valuation is a little kooky right now and full of a little bit of hopium, which is great because it makes people a lot of money. And I think it's a great opportunity to sort of diversify or set some trailing stops, right? Like milk it while it's going up and then stop out 20% on your way out so you build up some cash. Like, what's wrong with that? So anyway, that said, Nvidia obviously has earnings tomorrow. Bottom line of that is that sort of lets me adjust what I think things are worth. But if we look at Nvidia's earnings tomorrow, we're expecting earnings per share of 0.87 per share. So call it 88 cents of adjusted EPS. Non-adjusted, we're at about 79 cents. Revenue, 43.3 billion. Net income of 21.6. Nvidia typically beats. We're talking 7 out of 8 to 8 out of 8 times. So basically they always beat. It's just a matter of how much and then what they say about Blackwell. I mean, honestly, Nvidia's been on a little bit of a downtrend for a while. Maybe these earnings will finally be the earnings that let them break out. And if they break out, they'll break out to 164. Take a look at this. Look at this ceiling you've got right here. Reject. Basically, this downtrend kind of continues. You could draw this probably a little bit more cleanly, but whatever. You get the idea here. This is sort of the channel. That's what I drew, is the sort of channel that you're in right here. And I think you could break out of this and get to 164, which is, that's a fib extension. So, yeah, that could be very interesting for Nvidia. 164 could be a reasonable target afterwards. Unless they have some kind of like bearish topic regarding growth or whatever, but I don't know. I guess maybe I'm just not seeing that bearishness. I do see competition from, AMD. And you could directly see that competition because some data centers are now concerned that NVIDIA is going to sort of walled garden them in like Apple does. That's actually led to a rise in AMD's UA Link. This is a consortium by like Dell and AMD and others to basically compete with NVIDIA's InfiniBand, basically wiring your data center with NVIDIA components and switches and everything. So like everything is married together and really happy and it's all the same product, the same company, it's all unified, kind of like Ubiquity. Well, there have been some walled garden concerns and that's what's given AMD a little bit of a rise here. And so, AMD's been ramping up their MI350, that's going to be especially important here now because of all the Chinese complaints about, oh no, we're not going to be able to sell some of our Chinese products to China. Yeah, whatever. They'll be fine. So I think right now the only thing that's kind of keeping AMD and NVIDIA stock growth down, like how much they're returning year to date, is fear that their growth will be revised down. I think the stocks are kind of already discounting that off the pegs. Because, I don't think I said it, but, at 169, justifiable for NVIDIA, you're at like 185. Current Wall Street estimates, right? Mine a little lower. 269 for AMD, you could be a $254 company or stock, right? So that's a double. That's nice. So it's looking good. I think some of the China tariff fears have already been priced in. So basically you have these two massive price or cash cows. The fears about discounted growth and tariffs, I think, are kind of already built into the stock. And I mean, it would really have to take hitting like a wall or something to get, in my opinion, these stocks to just perform really poorly over the next few years. But it's possible that they do, should that wall hit. I mean, I guess we'll get a little bit more color tomorrow. But I mean, I'm wearing my Jensen jacket because Jensen is not the guy who's going to tell you bad news. That said, that doesn't mean the stock's going to go up. Last time NVIDIA had earnings was February 26th. And the stock went straight down right after that. Now, in fairness, that was also in the lead up to Liberation Day. So a lot of things went down over that period of time. We were in a little bit of a bearish downtrend. So who knows? Anyway, that's what I got for y'all today. Thanks so much for watching. We'll see you in the next one. Goodbye. Good luck. Hey, quick reminder, if you want to earn a 5% yield plus all of the upside in my real estate startup, we are offering a non-accredited investor round where we will pay you a 5% yield plus you get all of the upside in the stock when your stock converts in the future. It gives you an opportunity to diversify away from rich stock market valuations, diversify away from most tariff risk, diversify away from the craziness of the treasuries market, especially with these Moody's downgrades. You diversify into fixer-upper real estate, which is what I believe I do best. This is my baby. I call it my little Berkshire Hathaway. Now, maybe I'm biased, but I've got over $5 million of my own money invested into this business, and I'm so excited for what I think we're going to be able to do with this business over not just the next years, but the next decades. So if you want to invest in my real estate startup, go to househack.com and know that I will do everything for this business in my power to make sure we can do the absolute best that we can. Make sure to read the solicitations and disclosures on the HouseHack website, because there is risk with every investment.